Greetings and welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments to predictable pro-entrepreneurship, pro-growth states like Florida and Texas. Today, we are reviewing how to legally move your existing LLC or corporation out of Arizona to a new state to avail yourself of tax benefits among myriad other advantages. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, Arizona has made real progress. In 2021, the state enacted a flat individual income tax rate of 2.5%, replacing a graduated rate structure that previously topped out at 4.5%. That rate is among the lowest in the country for states that impose an individual income tax. But keep in mind, some states do not impose individual income tax at all. More on that in a moment. Arizona also has a corporate income tax rate of 4.9%, which places it in the lower third nationally. Not great, but not terrible. The Tax Foundation data show that Arizona derives 47.1% of its total state and local tax revenue from general sales taxes, 12.9% from individual income taxes, and 4.2% from corporate income taxes. Arizona has positioned itself as a pro-business state, and that's true to a large extent, and it has attracted population growth as a result. But, and here's the but, Arizona still imposes an individual income tax at 2.5%. It is not zero. Florida imposes no state-level personal income tax. Similarly, Texas imposes no state-level personal income tax. For a business owner operating a pass-through entity with $500,000 in annual income, 2.5% per year is $12,500. Over 5 years, that is $62,500. That's a fairly nice new car. Over 10 years, that is $125,000. That is money that does not leave your business and instead stays in your pocket or in the business if you are domiciled in Florida or Texas. Arizona also faces fiscal headwinds that may put its rate structure under future pressure. The Pew Charitable Trusts reported that Arizona estimates conforming to federal tax code changes under House Proposal Number 1, which will produce at least $100 million in general fund losses across multiple fiscal years. That is a problem for taxpayers because when a state faces a 9-figure budget shortfall, the options are to cut spending or raise taxes or draw down revenues. Now, Arizona's 2.5% flat rate is a legislative achievement, to be sure, but it is not a constitutional guarantee like Texas has. What the legislature enacted, the legislature can amend or repeal. And history has shown that states under revenue pressure tend to reach for the income tax lever first because it is the fastest mechanism to close a budget gap, at least in the short term. Arizona's corporate income tax rate of 4.9% is lower than the national average of 6.57%, but it is not lower than Florida's 5.5% rate, which applies only to income exceeding $50,000, which does not apply to most business owners because tax through entities are exempt. And it is not lower than zero. Texas, and I say that because Texas does not impose a corporate income tax. It applies a franchise tax only to entities with at least $2.47 million in annualized total revenue. For small and medium-sized businesses that fall below that threshold, Texas imposes no entity-level tax at all. Now, Arizona's combined state and local tax rate is among the higher rates in the country, which adds to the total cost of doing business there. Property taxes in Arizona are moderate, but the sales tax burden is real for businesses with consumer-facing operations. The total tax picture, individual income plus corporate income plus sales tax, matters more than any single rate in isolation. Redomestication is the lesser known legal process of transferring a company's state of domicile to a new state without dissolving it, without creating a new entity, and without triggering federal income tax when performed in compliance with the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. The company retains its existing federal employer identification number, contracts, credit history, and bank accounts because the entity that exists after redomestication is the same legal entity that existed before. Foreign entity registration, also referred to as foreign qualification, does not change the company's domicile. In fact, it keeps the entity anchored in Arizona and merely adds a second state of compliance with ongoing fees, reports, and tax obligations in both jurisdictions. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new entity in the destination state, may require a new federal employer identification number, and can trigger tax consequences and the requirement to assign, novate, or renegotiate existing contracts, which leads to operational disruption. Finally, dissolution is really not an option at all. I mention it in the interest of completeness because, unfortunately, this seems to be a common refrain among certain CPAs and even some attorneys. Dissolution terminates the company. It is not a relocation mechanism. It is a liquidation mechanism, as in going out of business. For a business that intends to continue operating, dissolution is the equivalent of burning down your house to move to a new neighborhood. Redomestication, when paired with a change of personal residency and a reduction or outright cessation of business operations in Arizona, can reduce or even eliminate state tax exposure for the entity and its owners. Now, to recap, Arizona is not a bad place to be. In fact, it's better than most states from a tax perspective. But 2.5% is not zero. And the difference between better and best is measured in dollars your business and family will never get back. If you have questions regarding potentially redomesticating your existing LLC or corporation, please use the link in the description for more information on this legal process and to schedule time for you and I to speak one-on-one about your specific situation. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature. It is not legal advice because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.